Hello guys, and welcome back to That Investing channel. Today I want to discuss a very impressive dividend growth stock that I've recently started a position in. This stock is not like my normal companies, which are mainly highly recognisable or tech focused stocks. They're the likes of your Amazons, Salesforce and of course Microsoft. This one is actually in the energy industry, which I know is very volatile, and I may be opening myself up to a bit of ridicule here with this one. But I was just massively impressed by their Q2 earnings, and they have plans to raise their dividend by 15% next quarter and have recently increased their share buyback program by $4 billion by 2027. Which as a shareholder I'm very excited about. So I want to talk about the potential I see with this company, my plan for holding them, as well as their competitive advantages I see with this particular stock. At the end I'll talk through this one's valuation, see if it's looking at a good price right now, which obviously I think so as I recently bought into it, and we'll see if we're getting good money for the fundamentals that we would be paying for. So if you fancy that, please stick around. If you enjoy this video and get something out of it, then please feel free to give it a like and maybe consider subscribing to the channel. It really helps me out, and of course it will keep you up to date. So the company I bought into recently was Cheniere Energy, ticker symbol LNG, which is the biggest supplier of liquefied natural gas in the US, which is ironically given the same ticker for they produce LNG as well. Now this is a mid-market cap company and it sits at just over $40 billion there, and is actually the second biggest supplier of LNG worldwide behind Qatar Energy. Now, their infrastructure going into this year can produce roughly 45 million metric tons of LNG per annum at two locations which are all in the US. They've got their flagship facility, which is the Sambian Pass SPL LNG terminal, which is in Louisiana, and that has 6 operational trains and is one of the largest LNG production hubs in the world. Meanwhile, their other facility, the Corpus Christi LNG terminal in Texas, has ongoing expansion projects to meet increasing demands as well. And they are producing LNG in that facility at the moment. Now, their previous returns in share price, they sort of speak for themselves and speak to the achievements in growth and rewarding shareholders that this company is able to achieve. Now, they're up over 200% in the past 5 years, without discussing that dividend, which they only recently started paying in 2021. And they've raised that to around a 1% starting yield at the current share price. So it's not the biggest yield, but it's growing considerably rapidly. With that dividend growth perspective, they've now cited their intention in Q2 to grow that by 15% in Q3 to around $2 per share of 2024. And then the pre-years after that, they're planning on growing it by 10%. And they originally stated 10% quite a few quarters ago. So they've actually upped their guidance in terms of dividend growth quite recently. So that's pretty well covered by the free cash flow as well. If we just take a look at that, it's sitting around the 10% range with plenty of growth in the horizon for free cash flow in the future if they want to carry on paying this out. And they want to get to a payout ratio sitting around 20%. So it's very safe and is got plenty runway for growth. Now, to lay out the structure of my video on this particular stock, I'm going to be going through Cheniere's competitive advantages first, their growth to free cash flow, and of course ending a bit with their capital allocation, and then work on their valuation. There's lots of reasons to like this company. You can't just judge it based off what they are actually producing. We have to look at the management team and the company as a whole, which I really like. Now, for those that would be concerned about investing in natural gas companies, which I would understand, we can see by this graph, natural gas as a commodity varies greatly in price and can prove very erratic in the past, recently reaching all-time lows in March 2024. This, of course, can affect the liquefaction companies, which LNG is one of, that are purchasing volumes of natural gas to liquefy. So they have to buy the gas, and if the gas is more expensive, it affects their bottom line. However, part of the competitive advantages of Cheniere Energy is that their long-term contracts and agreements are hedged against the commodity price fluctuations. In English, it basically means that Cheniere Energy have long-term contracts where they essentially hedge their bets, if you like, and stop this price fluctuation affecting their bottom line. Effectively, if the price fluctuates, they agree on the new price. They don't agree on the old price or what they originally agreed when they started the contract. So that's actually very helpful. So as it states here, they have contracted around 95% of their future production until 2030 and beyond. Recently signing a massive deal with GALP, which is a 20-year contract to provide around 0.5 million tonnes of LNG per annum from 2030. So they've got plenty of time to achieve that in their production, and their construction is actually ahead of schedule. With most of these long-term contracts that Cheniere Energy actually have, they sit an average waiting of around 17 years in terms of length. So they've got plenty of runway for growth there. It's not just going to stop overnight and get cancelled. Now, these contracts take two forms: SPAs, or sales and purchase agreements, which are for Cheniere's customers. And these agreements require to pay a fixed fee with respect to contract volumes. So that's irrespective of their election to actually use the LNG. So if they choose to cancel it, suspend deliveries because they don't need it or whatever, then they've still got to pay Cheniere Energy. Additionally, they have other agreements, so IDMs, in which the gas producer sells natural gas to Cheniere on a global LNG or natural gas index price. Now that's less with fixed liquefaction fee, shipping and other costs. So finally, they also have an agreement in place that offer a 5% uplift on contract fees if the price of gas, natural or otherwise, increases. So what this basically means and how it looks is essentially they've allowed the company the best of both worlds. Cheniere have limited the variable price of the gas on their own balance sheet and pass it on to their customer. So that 5% uplift on contract fees when the price of natural gas goes up essentially means that LNG end up just reaping the benefits of that on their bottom line. And they also capture that upside from LNG prices in the future, which provides overall less volatility when it comes to their bottom line. And additionally, with all this with regards to their competitive advantage, they have the largest reliable US supplier of LNG, and they're just in possession of the infrastructure to back that up, which is a massive barrier of entry to other competitors. They've got to have the space and the capability to build out the infrastructure that produces LNG and actually increases their bottom line. But there is competition in the likes of US players like ExxonMobil, who are expanding production in this area of the business. However, I would say they are less than a concern, with producing only around 8.3 million metric tonnes last year compared to Cheniere's recent 45 million metric tonnes. So they are producing a hell of a lot less. Which moves us along to their growth story. So Cheniere has two sites that they're seeing expansions on for the end of 2026 and the start of 2027. Now they specifically have 62% construction done for what they call Stage 3 at Corpus Christi, which is currently ahead of schedule and on budget. Now, Stage 3 is adding 7 mid-scale trains to the 3 operational trains already at the site. Essentially, trains is the full process of effectively producing LNG. It's how they liquefy the gas. Now, these trains are expected to add 10 million metric cubic tonnes to LNG's production. And the first train is actually expected to take on its first gas in Q3 of 2024 and complete later on in 2025. So, when completed, these trains are expected to produce more LNG than Exxon's entire production of LNG throughout the entire company. And they are actually currently at 62% construction. So, following this up with how they expect to grow that balance sheet, in the most recent quarter this year, they just smashed it. So if we take a look at this earnings report, they came in ahead of schedule with the construction of Stage 3, which we talked about. They've announced their intention for a 15% dividend raise next quarter, and an increase in their share buyback program before increasing their guidance for the year to 3.1 to 3.5 billion distributable free cash flow for 2024. And that was from 2.9 billion to 3.5 billion previously forecast. So they've been on the conservative side and they've recently increased that forecast for the future. Now this has had a massive increase in the share price in recent times after earnings going up over 10%. But I still bought into it after this because I think these numbers just mean it's still trading at a very good free cash flow yield relative to that elevated share price. Now, before we get into the valuation side of things, I just want to cover why I love their capital allocation as well. They have this initiative they call 2020 Vision, which is essentially how they plan on rewarding shareholders and making their balance sheet better. Now, they talk about their growth projects, which we talked about and have established that they're ahead of growth in that area. Now, they've also been putting about paying off long-term debt, which they've been doing more recently. However, there are still two things that I think are really impressive with this 2020 strategy, which we haven't really touched on that much. And I just want to reiterate it. So they've added additional $4 billion to those share repurchases by 2027, which is huge when we consider the fact they've already in the past 3 years bought back around 10% of their outstanding share count. And so they're aiming to do this again in the coming 3 years or so by 2027. So that's amazing in rewarding shareholders. Additionally, they're obviously planning on increasing that dividend by 15% next quarter to $2 per share and intend to raise it by 10% in the next decade to a payout ratio which is around double where it currently sits at 20% free cash flow. So to emphasize the point, this company is growing its free cash flow and raising guidance on that growth, using it to buy back shares at a quick rate, buying around 10% of their market cap in the past 3 years. They're also doing this whilst raising a dividend in the double-digit percentile ranges, 15% this year and 10% in the concurrent years. So when we look at all that, that's amazing. But what are we paying to get that sort of company? So if we look at the valuation and what it offers at the current share price. So if we look at historical metrics first, we can see that historically the yield has sat higher, but currently sits at a free cash flow yield of 8.5%. This is at the same time that Treasury bonds sit around, and AA bonds sit around 4.2% for the next 5 years. So as the intelligent investor states, this gives us an indication and a margin of safety with a possible upside on this stock, because the free cash flow yield sits that much higher than the yield you'll be getting at a risk-free rate with corporate bonds. However, from looking at historically, we can see that the average has been a lot higher. So maybe this is a case that this company has improved and gone up considerably in share price, which it has. Now, I would say this is because in the past they've been less than certain about their future. But this uncertainty has reduced considerably with their long-term contracts, the likes of GALP and other ones. So this moves in with the free cash flow numbers being a lot more predictable going into the future. So that's why part of the reason I've opened a position in this one. So moving along to the price to free cash flow, we can see it actually sits at 11 to 12, which they are expecting to grow significantly in the coming years, in the next 3 or so years or so, with these construction projects underway. Now, if we take their goal and expectation of $20 in distributable free cash flow per share by 2027, if they do everything with the construction projects and it goes well, so around 3 years from now, using a multiple of around 16 times price to free cash flow, we get around $320 per share, which if we divide that by the current share price gives us around an upside around 70% from the current share price, which is a return in around 3 years or so, and trading at a higher multiple than it is right now. And we have to consider that they're already ahead of schedule with these construction projects. So to capture this even more, if we do a DCF and forget the previous earnings, see what it is currently priced in for the next 5 years. The market is currently pricing in around a 1% free cash flow growth per annum, trading at around 16 times price multiple, not even the current metric. So we're trading at a higher multiple than we're currently seeing. So there's not much being priced into this stock in terms of growth, which has a rapidly growing dividend over 10% and is planning on buying back another 10% on its total share count, to 2027 to around 200 million shares outstanding. So to me, the value to the price is very good, and their capital allocation you are getting for this price over the next 3 or so years is just excellent. Now, there is risks, and we've discussed that with the likes of natural gas and the volatility, and I don't think this company is an exception to that, but I believe it manages that risk quite well, and the free cash flow yield you're getting for this price is very good. Now, it's only a small position in my portfolio, and that's sort of hedged against that gas risk, but it's sitting at a close to weighting around 3%. So I'm not massively invested in this one, but I'm actually very interested to see how it performs. It's a bit of an experimentation on me. I've done my research on this one, and I want to see what happens with this stock, because I don't see much downside, but I see potential for very good upside. Now, it is still over £1,000, which is a lot of money to me, so we'll see how it get on. But tell me what you guys think. Do you like this one? Let me know down below. And as always, thanks for watching. I appreciate it, and I'll catch you in the next one.